Let's drill into those bank earnings with a guy. He didn't start watching this sector today or yesterday. Rob Wessel, former bank analyst and now executive chairman at Hamilton ETFs. It's great to see you.
Oh, thanks for having me.
Overall, Rob, you say the banking sector is not cheap and there's an element of price for perfection here?
Yeah, I mean, for sure. So, if you look at the quarter, it was pretty good. It was a very good quarter. It was very broad-based. If you look at the big three, whether it's margin loans growth, whether you look at credit, look at capital markets, it was very broad-based. There was no one single thing that kind of drove everything.
For these two banks in the latest quarter.
For these two banks, that's right. And the quarters were very, very similar. They had almost all of the same trends, roughly. And but at the end of the day, certainly writ large, the overall banking sector, not these two banks necessarily, they're priced, they're pricing in some good news, or at least not bad news, right? They, as of yesterday, I think they traded at 12 times 26. That's a pretty good multiple when the ROEs are in the low teens, and 11 times next year. So, good quarter for sure, broad-based, consistent, that's a positive. On the other side, the valuations for the whole sector reflect that.
Talk to us about Bank of Nova Scotia, because that stock not at record highs yet.
No.
Does it look cheap, comparatively speaking?
Yeah, so I thought today is pretty interesting, because today was the low ROE bank day. Tomorrow's the high ROE bank day. But what's interesting is these two banks, Scotia and BMO, both have about a 12% ROE. And both of them, if you look at Bloomberg's forecast earnings per share growth, is almost identical. And yet you could drive a truck through their valuations. So, you have BMO, as of yesterday, trading at over 12 times 26, and you had BNS trading in and around 10.4. So there was a nearly 2 multiple point spread. And
that's big for banks.
Yeah, absolutely. It's big for bank stocks where the two banks have roughly the same operating metrics and roughly the same growth profile. So it's pretty interesting. I think what the market is saying is a couple things. For Scotia, you asked about Scotia, I think the market's saying, we're skeptical that they can make ROE improvements and that we can get
Scotia.
that. Yeah, Scotia. They can get that ROE up to 15 or something like that. So they're trading at a very big discount. For BMO, even though in the here and now, the ROE is the same as Scotia, the EPS growth forecast is about the same as Scotia, the market is clearly saying, listen, we got a lot more confidence that Bank of Montreal can get its ROE improvements. What's interesting is that that's somewhat of a singular bet, because they made the biggest acquisition in Canadian bank history, Bank of the West, and that has had, I don't think anybody would say, hasn't had anything other than very disappointing credit experience. So you made the biggest acquisition of Canadian bank history. That acquisition has not gone particularly well, certainly from a credit perspective, but the market's saying, you know what, we think it will go better, and therefore it'll drive greater ROE improvements, and we're prepared to pay more for BMO today on a PE basis than we are for Scotia.
What about Scotia? We are going to hear from Scott Thompson, the CEO, tomorrow in the 11 a.m. ET hour on BNN Bloomberg. The market is less confident in Scotia?
Well, I mean, by definition, if you trade at a significant discount, the market is saying, we're going to pay less for a dollar of earnings for you than everybody else.
Yes.
Probably that either comes from two things. One is we think your EPS growth profile is going to be lower than the peers, although that's not borne out by Bloomberg forecast estimates, where it's actually higher than everybody but BMO. I think what they embedded in that has to be part of, we don't like your business mix as much, and we don't think your ROE can get higher, right? Because it's both BMO and Scotia are around 12%. So, the market seems to be saying, we think Scotia is going to be mired in the 12.5, 13, or at least still lagging their peers.
Why is that?
Well, that's a good question. I mean, I think for BMO, it's really the negative. It seems like the market is saying, we think every other bank can maintain its ROE or improve it, and for Scotia, we're more skeptical. Probably in part because they don't have as much confidence in the international platform, in part because of the mix and things like that. But also, there's always this question about Canadian banking and Scotia and whether or not they lag their peers and whether or not they can make up for that.
Rod, this is a question that fascinates me, that should Canadian banks even buy stuff in the US? Because the profitability is much less. Why don't they just stick to this market?
Yeah, so this would be a 1-hour segment if you wanted to keep going on that. There's a lot to be said for, I think it's interesting because some of the banks have been very successful at their foreign expansion strategies. And we would say the big reason for that is diversification. They did not make one giant bet on one thing, right? So if you look at Royal, they got capital markets, they got retail brokerage, they got a kind of a niche high net worth bank in California. and they have some asset management globally. And writ large, that's served them very well because they've not had that massive ROE dilution that comes from one big bank, one big bet, a la TD, for example. And then you look at National, they also had a fairly diversified foreign expansion strategy, kind of little things here and there.
Cambodia, I think.
Yeah, Cambodia, Credigy, a few other things. And those two banks have sustained much higher ROEs in no small part because their acquisition strategy has not dragged ROEs down. So to your point, should they have just stayed in Canada? Probably there's an argument for no, that there was still room for them to create shareholder value elsewhere, where I think you've seen, with the benefit of hindsight, and not something I would have necessarily predicted, in fact, not something I did predict, these monoline massive bets on like TD going all in on the US, obviously with the benefit of hindsight, has created all kinds of regulatory risk, all sorts of ROE dilution, all sorts of shareholder destruction. And BMO has also made a singular bet, and its ROE is down, right? So now BMO bought M&I for a cheap price during the financial crisis, so it's a little bit different. But yeah, there's an argument for a smart, controlled, incremental, diversified expansion strategy, which seems to have worked better than this, the big bet strategy.
So who are the glamorous players in the sector in terms of return on equity?
Oh, Royal and National. Yeah, they're the clear leaders, and not surprisingly, they traded at the highest multiples, and not surprisingly, over the past 10 years, they've had the highest EPS growth.
It's interesting, Royal, I mean, they're so big, but with a big equity base by definition, but they earn a good return on it.
They're very smart. But yeah, I think having a global investment bank in the top 10 has been a big driver. A lot of that growth was funded organically rather than through acquisitions, which is more ROE friendly, and not going all in on one thing and paying 3 times book, which is what TD paid more than 3 times book for Commerce pre-financial crisis. That results in a lot of ROE dilution. BMO, it's been a bit different, obviously, because they got M&I during the financial crisis and they got Bank of the West at a reasonable multiple. But the bottom line is the banks that have highest ROEs, one thing you can take from them is two big differences. Number one, they have more capital markets. And so they have more benefit from trading, more capital incremental generation from trading in their capital markets. The second thing is their expansion strategy is more segmented among different businesses, not just one big allocation.
Where does CIBC fit into the mix?
So CIBC deserves more credit, I think, than they get. Maybe I'm talking a little too early because they haven't reported yet.
Okay.
But I mean, CIBC, they made the one acquisition, Private Bancorp in Chicago, which was a very well-regarded mid-cap bank at the time. But I don't know that they don't get enough credit for not making any mistakes. So they've not made a significant amount of allocations or acquisitions, but they also didn't make any mistakes either. So it's a bit surprising that the market says we prefer Canada. So here's a bank that has a lot of Canada. We don't like acquisitions. So here's a bank that didn't make a lot of acquisitions. And the market's giving you a bit of mixed messages because CIBC still trades at a discount.
We're tied for time, but
Sure.
Is the banking model going to come under pressure in the decade to come from other providers, non-bank providers?
I don't know. I've been following the sector for more than 30 years, and that's been an ongoing question. I think I've had this question probably for 25 plus years, including on BNN. I don't know. I don't think so. I mean, they're very good at changing their distribution model, much more electronic delivery. They have massive embedded advantages with their core deposit franchises, with their branch network, which they've reconfigured. So I don't think there's any evidence to suggest that the model is going to come under pressure.
Rob, always great talking to you. Thanks very much.
No, thanks for having me.
Rob Wessel, Executive Chairman at Hamilton ETFs.